Today I will firstly explain the steps in the final project. Then we will cover comparison methods, which is some parts from this chapter, because next week we have quiz. So I first open my screen. That's it. Yes. Here, the Excel file that we use in our project. So you can see we have two individual stocks. As a sample, I use Netflix and Apple. Your stock is different, but still from the United States, so that you can reach the time series data. And then here we see how we can estimate capital assets pricing model, okay, here, and the regression output, and how we can estimate arbitrage pricing theory, which means that we use macroeconomic factors to forecast individual stock returns. Then this is its regression. And then we have here, let me open our project firstly. Okay, you can see we have capital assets pricing model. And then we have arbitrage pricing theory. It starts from here. Okay. And then we have portfolio optimization. So we will try to do all of them. Okay. And these are the graphs. So I will also show how we can just estimate the regression outputs and how we can draw the graphs. Okay. Firstly, we need to download the data. So you need to go to investing.com, okay, and then find your stock exchange. Mine is Netflix and Apple. So I will show how you can download Netflix firstly. So we go to historical prices in Turkish tarihsel veriler. Then we go to here, and then we change. First, we just change to monthly data in Turkish aylık. You can also use English version of this and investing.com, because I use tr.investing.com. So again, you will reach this United States Stock Exchange. Okay, and then I go to here. Okay, I change the data from starting 2024, let's say, and January 1st. So 2014 to 2025, and then I apply. Okay, so here you can see this data goes to January 2014. Okay, and then I need to download it. So we go to here, we say download. So we first go to our stock exchange, historical series. We change the time frequency as monthly in Turkish aylık. We change the data selection from 2014 to today, and then we say download. So we downloaded the data. Okay. So here, how we can transform this data? We will first select all of them. Okay. Then data, convert text to variables. Okay. So we select comma, because our separation is comma, and then we finish. So what we know about Netflix data, let's look at 2025 Netflix return is 109.35. Okay, so here I have this data. I take this data series. Okay, Then here we have time format. Then I say rank then rank from yeah, okay, this one. Rank for rank command from biggest to smaller, which is descending order. And then now we have the data. But what we know, since I use dot instead of comma, I change it to numbers. Okay. So let's look at how it looks like. So it is Netflix monthly changes. Okay. Then, so you will take this data, okay, and pass to here. Okay. But since now we have less observation, let's look at how many observations I have. I have 130 observations, so that I can go to here and select from last to okay, how many observations? 130. Okay, it is. I can select 130 observations. Okay, then pass to our calculation here, right? So anymore, you will use data because it's the total number of observation is 130. So 130 observation is enough. So in this case, what you will start? You will start from March of 2015. So when you try to download, select the data period here, starting from 2015 March, okay, and then apply. Then you will see that starting period is March 2015. So when you just paste the data for this your stock exchange, it will calculate. So what about Nasdaq 100? Normally, Nasdaq 100 is not equal to this variable, but I haven't updated so that you can use it. It doesn't matter. Okay. So, or even we can just, I can just show you how you can download Nasdaq, and then you also need to update Nasdaq observations. Okay. I can also update the file and then upload to UZEM system. Okay. Let's take Nasdaq. But since here you can see the sample, okay, the sample contains the old data, you will see these coefficients are not in line with our new estimations. Therefore, I will keep the old one, but I will send you Nasdaq from March 2015 to today, and then you can paste Nasdaq to this area, okay? So I will not change the original file, but I will send Nasdaq price change as a separate file. So let me update Nasdaq for you here, how you can update it. You don't want to wait. Nasdaq investing again. Okay, this is Nasdaq 100. And then again, historical series. Okay, historical series. (2015) March, 1st of March. and apply. So now, but it is monthly 2015. Let's find it. March and 1st of March, and apply. So now we have the data starting from March 2015. And then we download it. So now we have Nasdaq data. Again, data, convert text with comma, and then select it. Here we have problem with comma and dot. If I first change dots, then comma to dot. Okay, and then I have rank from 1 to 3rd. And data, rank from biggest to smallest, descending order. Now this is the Nasdaq data, as you can see. So let's see what is the difference between our new data and the old data. Okay, here you can see the Nasdaq return is here. Okay, here we have the same observations. As you can see, since the time period is now different, we have a shift. You can see that the data are completely different. So I will just select this one and update Nasdaq file. You can see, right? So for capital SS pricing model, you can see when you just paste your first stock return, because what I said in the project, as you can see, the first CAPM, we select the first stock exchange, Netflix. You will look at your Excel file, the file that I uploaded to XAM system. You will see the first stock exchange, and it is your first stock exchange that you need to use for capital SS pricing model. Okay, here. Then, what is capital SS pricing model? We have return of asset minus of risk-free rate, which is treasury bill rate, alpha, which is constant, plus beta, which is slope, return of market, which is Nasdaq, minus of risk-free rate, and error term. So here, these are the explanations. When beta is bigger than 1, it means the SS is more volatile than market. If it's equal to 1, it means that it's just the movement of individual stock exchanges in line with same as Nasdaq. And if it's smaller than 1, it means that SS is less volatile than the market. Okay, so here, these are the explanations. This is the graph that you need to update here. When you look at the Excel file, it is already calculated, as you can see. You need to take this graph and then paste it here. Then what about regression analysis, how we can run it? Because here we understood that we have a regression equation, which is a linear regression equation. By the way, as you can see, I also need to update risk-free rate because it's from the old data. I can also upload and send this file to you. Okay, so let's now take, since we understood that how we just updated data, I will just save as different. Then look at the old data because the estimations are from old data. Okay, so I'd like you to receive the same output. So here are old data. So we understood how we need to update data, upload the data from investing.com, and you also need to take your second stock, individual stock, in my case is Apple. In your case, you need to look at your stock exchange and then take the first and second, and then download and convert with this same approach. Then for that capital assets pricing model, I need to run a regression analysis. How we can run it? So I would like to receive this output, which means that we have a constant in Turkish kesişim and slope. Here, the variable name appears, as you can see. So I go to firstly data analysis in English, okay, in Turkish veri çözümleme. Okay, now we find regression here, and then we find y. So what is y? Look at the regression equation. Your individual stock return excess return, which is adjusted from risk-free rate, is already calculated here. You also need to take the data, okay, and then your independent variable is here, return Nasdaq, right? And then since I selected the headings, labels, select labels here, and then I run the regression. So look at the regression output here. This is the same as regression output, you can see. Constant 0.14, and the return for slope here, which is the market excess return, 1.29. And then I also explained how you can evaluate a regression output. You can see I evaluated coefficients separately. And then what is the meaning of this? You need to update these coefficients and then evaluate. If your coefficient here 1.29, is it statistically significant? Yes, as you can see, it's nearly 0, pardon. Here you can see this 1.95 E minus of 0.9 means you put 9 zeros. I can even show you here. You can see you put 9 zeros, so that if you just have a statistical significance of 5%, then since it's less than 0.05, you say, okay, this coefficient is statistically significant. This is the evaluation steps. If I just take it here, it is statistically significant. And then what is the meaning of this 1.29? Look at our data. We take the return of adjusted returns. Since we take return, we directly evaluate the coefficient as percentage. Okay, so that what does it mean? If the market's excess return increases by 1%, excess return is expected to increase by approximately 1.29%. Okay, so here, this is the capital assets pricing model estimation, how we just do this. So what you need here, as you can see, you need market return. I will send a separate file and we will paste it. You also need to have updated risk-free rate here. I will also update this risk-free rate and send you today. Okay, both risk-free rate and Nasdaq return. This will be updated for the new updated observations, because these are from old data. When you just paste your new data, I also need to send you Nasdaq return, Nasdaq trust chains, and 3-month treasury bill rate. Okay, both of them I will send. I will also send other variables, but I will explain in the next step. So if you have any question for capital assets pricing model, I can answer, and then we can go to the next, which is arbitrage pricing theory step. Yes, any question for capital assets pricing model? Any question? Okay, then we can go to next step, which is, so we
I have a question.
Yes.
For the regression part, regression analyze, should we calculate both of the firms or only one of them?
Okay, for regression analysis, what I say, you have two firms, first firm and second firm in the Excel file. For capital assets pricing model, you take the first firm. For arbitrage pricing model, as you can see, you also again take first firm. Both firm is used for portfolio optimization in the last step, right? So you will take the first firm and then estimate the regression analysis for only the first firm, not both of them, right? So here, let me project groups, open it. For instance, first group, you can see here, their stock exchange for arbitrage pricing theory and CAPM is first variable, as you can see. Portfolio analysis with additional stock is the second one. So you need to select your data, okay? First stock exchange, individual stock, and then you will use for capital assets pricing model and the branch pricing theory. Yes, another question? No, okay, now we can just start arbitrage pricing theory. So what's the meaning of arbitrage pricing theory? It means that, let me open it. So we understood capital assets pricing model. I also explained this model with its theoretical background in class and why we just try to estimate the capital assets pricing model, because we try to see if our individual stock return moves with the same direction of market return. But what we know, we also understood and learned that we have a risk-free rate, which means that we try to expect at least this return. If the risk-free rate is 3% in the United States, then you expect that because you take risk when you just buy stock, you expect that individual stock return is higher than risk-free rate because you take risk. Therefore, we use capital assets pricing model that adjust return of individual stock and return of market with risk-free rate, then use these variables in the linear regression estimate, because we have linear regression estimate. Even it's not multiple because we have only one independent variable. In our case, independent variable is excess market return. In other words, adjusted market return. How we adjust? We adjust from risk-free rate. Then we just take this formula and then we go to here. When you just paste your own stock, for instance, I think it's like for other students here, we have first one, ARM is the first stock. So for this group, they will just put ARM. I will provide Nasdaq and Treasury bill, which is risk-free rate updated values. You will paste these variables as well. Then you will have this. If you don't change any part in Excel, it will calculate your returns. Then you go to data analysis, and then you find regression in English, regression in Turkish, regression. Then you just select Y as your excess stock return, which is return of Netflix in my case. In your case, it's your own stock. And then for X variable, which is independent variable, it is excess market return. Okay, it's also selected. Since you select the variable names, you say select levels as well here. Okay, here. Then when you say okay, you will have a regression output, and then you use this regression output. And statistical significance here, as you can see, is same as individual stock because you have only one independent variable. So we will look at arbitrage pricing theory in next. So in arbitrage pricing theory, here you can see you need to just paste your own stock here. Then I will provide, as you can see today, I will send it. These variables, you can see that we have too many variables here. Which variables we use? You can see we use our individual stock. We use industrial production, inflation, and 3-month treasury bill, which is taken here from, normally, I think I applied it part here. Normally, pardon, it's 10-year minus of 3-month treasury bill. Okay, it's here normally. I even updated for previous years so that it's like here. You can see this one, right? I will also link and send it to you. So it's like we have updated data, but since it's an old estimation, I think, because it's an old data, a 3-month treasury bill rate here. Okay, let's run it. So Netflix, so let's look at arbitrage pricing theory equation firstly. Okay, this is capital S pricing model. Arbitrage pricing theory. As you can see, we have excess return, which is Netflix, industrial production, inflation, and 3-month treasury bill. So as you can see here, we have 3 independent variables. I also explained in class for this arbitrage pricing model part that we have macroeconomic factors. So these are macroeconomic variables that can affect excess return. Like we just think that if industrial production is increasing in a country, then stock prices must increase because increasing industrial production means we have an expanding period. Inflation, we know that inflation damages for firm sales, real sales. Therefore, we just think that, okay, we have negative impact on inflation on excess returns. What about inflation differential? What is the meaning of inflation differential? We have 10 years treasury bill rate and 3-month treasury bill rate. If we take the difference between 10 years and 3-month interest rates, if we have a larger difference, it means that we have higher risk. So we just expect that if we have larger risk, then our excess return, which is adjusted induced stock return, is decreasing, so negative. I explained each of these variables can affect excess market return. So we also have a multiple linear regression analysis. So what's the difference between the first version? In the first version, we have only one independent variable. But in the, let's say, this multiple version, we have more than one, even 2, 3, 4, 5, whatever it is, okay? So here we have arbitrage pricing theory. And then we have main macroeconomic factors. I also explained in your project, you can see we have each of the slope coefficients, what they try to estimate, or what's the meaning of each of them. For instance, beta 1 is the sensitivity of individual stock returns to change in industrial production. Beta 2 here, sensitivity of individual stock returns to change in inflation. And beta 3 is the sensitivity of this individual stock returns to change in interest rate differentials, which is difference between 10-year and 3-month treasury yield. So it is a common measure of yield curve steepness. Like if we have a very large difference, which means that in the future, you expect that recession period will come because you give higher prices for future, which means that interest rate for future is higher. Then we have problem for future. So that it's a kind of measure for economic expectation. Therefore, we just use this interest rate differential as a macroeconomic factor for excess return. And here E is an error term, which is the regression residues, you can see. So let's look at our arbitrage pricing theory. Again, we say data, or we find data here. Data analysis, then we go to regression again. Now we need to select our own data here. What is Y? In this case, Netflix, which is individual stock, is again my individual stock return. So what is X anymore? X, we have 3 X's. So you select all of them. Okay, here. And then since I have labels, headings, I select etiketler. Then I run the regression output. You can see here, regression is overall significant. How we just understood that regression was overall significant? Because its p-value for ANOVA, which is F statistics, is less than 0.05. I even explained here overall significance, as you can see. And here, coefficient, slope coefficient, constant coefficient, kesişim, industrial production, inflation, and treasury. As you can see here, the p-values, let me just see them. All of them are statistically significant, even constant. So industrial production, as you can see, is 3. It means that I also explained here, since I just updated the data, my output is a little bit different because every year I update the data. But let's suppose this is my output. Okay, industrial production is 3.08, inflation is minus 14.66, and interest rate differential is minus 7.61. So each of them I explained. So you need to update this firstly graph for arbitrage pricing theory. This part is, you will keep it, which is an explanation of this model. Then this part is your graph. Even you will take it from directly. If I haven't drawn the graph, let me look at, where is the graph? Okay, so you just say add graph, and then let's look at how I did. We have scale. Netflix is in the right scale. Select Netflix is here in the right scale. So this is the graph. Okay. So you can change the colors. Okay. You can change the colors. For instance, this one. So you can change the colors and then take this graph and paste to Word file. And then you will see arbitrage pricing theory for individual stock, your first stock. This is regression output. And these are the explanations: model significance, intercept, industrial production, inflation, and interest rate differential. So you need to update all of these variables, graph, table, and the numerical findings you need to update, right? Then summary, as you can see here, industrial production has a positive and significant relation with Netflix excess return, inflation, strong negative, 3-month interest rate differential has a negative relationship. Then this is a summary. So you need to update it. So I will send you this. Okay. Nasdaq return, risk-free rate, industrial production, inflation, and interest rate differential today, so that you can paste and then run the regression, okay? And you can see that we also have oil prices. In some studies, they also use oil prices for arbitrage pricing theory. Therefore, I added, but I will not update it because you don't use it, okay? So we run the regression for main macroeconomic factors. Yes, any question for the second part, arbitrage pricing theory? Do you have any question?
Thank you, Doctor. I have a question. That can you please repeat what you will send it to us to use it? Like you will send us the data we will use, right?
Okay, no, you individual stock returns, you will take it from investing.com. Let's look at your data. For this Excel file that you can see, data for average pricing theory and CAPM portfolio analysis, you need to upload the data from investing.com. I will send you Nasdaq, industry production, inflation, 3-month treasury bill rate, and risk-free rate, so that you will paste this data, because these are old data. I want to update it with the new observations because time is changed. It's, as you can see, it ends with 2014, but your data will start from 2015 and then end with 2025. So you need to download your individual stock here. For instance, for my case, Netflix and Apple. I will provide you the variables. Let's look at our formulas. I will provide the variables for risk-free rate, market return, first, second. And then I will provide you industrial production third, inflation fourth, and then three-month interest rate differential fifth, so that you will other two of the stock returns must be downloaded by you, right? Via investing.com that I explained at the beginning of this course.
Thank you. Thank you.
Okay. Another question?
Hocam, for arbitrage pricing model, how can we find alpha, betas, and error rates?
It's here. When you just run the regression output, what I said, I run the regression output, and then this alpha, beta 1, beta 2, beta 3. These are the coefficients that we take it from. You can see alpha, but alpha is a constant. Kesişim in Turkish, okay? Constant, 0.83. Beta 1 is here, for instance, 3.08. And beta 2 is, as you can see, minus 14.66. And beta 3 is minus 7.61. So here you can see intercept, which is alpha, first beta 1, beta 2, beta 3, all explained. So is it clear?
Hocam, for each year between this 10 years period, should we calculate excess return for each month separately?
It's like here. You will first download it, and then when you, for instance, for CAPM, when you just paste your own data, here Excel will directly calculate excess return for each of the month. You can see every month it's calculated. So you only need to paste here. I will update this Nasdaq and risk-free rate. Then you will paste your own data, and then excess return is already calculated for each of the month. It's same as for capital assets pricing model. You can see here that in this case we don't have excess, but we directly use the stock return. Okay, it's although it's like, oh, okay, risk-free rate minus 3. Oh, okay, so this normally should be adjusted. Probably this Excel file I also need to update, because it takes directly Netflix right side. Okay, Netflix. But here in CAPM regression model, what we have, we adjust it from individual. Let's say we take the stock return and then adjust it with risk-free rate. So here, let's look at, I just need to link it to here. Okay. So now it's anymore new observations taken from the adjusted, let's say, excess return for Netflix, you can see, right? So I can also update the file and send to you.
Hocam,
Yes.
but we didn't define any formula. So how can it automatically calculate excess return without knowing the formula?
Okay, here let's look at CAPM. Can you see the formula here? Here, formula. Excel already calculates. It already calculates the excess return with formula. You can see. It takes.
So we don't need to create or define any formula.
You don't need, because when you just use this Excel template, it already calculates the formulas. Okay? Even for our pricing theory, you can see it already calculates. You can see, right? So you don't need to use any formula. Inside this Excel, each of the, for instance, excess return is calculated. Let's look at Nasdaq excess market return. Can you see the calculation here in Excel? It takes C14 minus C2, right? C14 minus C2 divided by C2, which is a growth rate for Nasdaq, and minus of this treasury bill rate, okay, divided by 100, because it's like a day, it's a monthly treasury bill rate. Therefore, I just divide by 100. So it's already calculated. You don't need to use any, let's say, formula. Okay, formula is already calculated inside the Excel file. So is it clear?
So we only show the results as a graphs, as a table analyze.
First, you need to you take the graphs, and then you need to run the regression and paste to this Word file, and then evaluate the result of Excel according to your updated stock and then results. So that we take this output and then evaluate the result. For arbitrage pricing theory, again, the same. You just need to update data and paste your own graph. You need to paste your regression, multiple regression analysis, and then update the result according to your multiple linear regression analysis. So this is arbitrage pricing theory estimation, right? So is it clear for until this point? Clear? Aydın, is it clear?
Yes hocam, clear.
Tamam. So now we understood that we have three parts in the project. The first part is CAPM model, which takes individual stock and excess market return. We learned the second part, which is arbitrage pricing model. We take the excess return, and then we just take three macroeconomic factors, try to forecast this excess return. Then we have portfolio optimization. So what we learned in portfolio optimization, let's remember last week and what we learned. for portfolio return, if you have two individual stock, we first need to calculate the expected return of this portfolio. So how we can expect? We need to separate our money for these two stocks. So weight 1 and weight 2 is like proportion 1 and proportion 2. And then what we know, the sum of this proportion is equal to 1. So R1 and R2 is the expected returns for asset 1 and asset 2. Then what we did, we took a variance of a portfolio, which is the risk of the portfolio, depends on these weights, variances, and covariance of these two assets. In other words, when we just convert covariance to correlation coefficient, the formula for portfolio variance will be equal to weight square first variance square plus weight 2 square second variance square plus 2 weight 1 weight 2 correlation multiple with standard deviation of first and second stocks. Okay, this is portfolio variance. You can see it's not an individual stock variance, it's portfolio. So what we understand from the formula, if we have a positive, which means that moving the same direction stocks, then our variance is increasing. If we just take negatively correlated stocks, then you can see that our variance is decreasing. So this is the formula. But the problem is here, how we can estimate weight 1 and weight 2. So in class, we learned that we need to use this formula even in your midterm exam. You used this weight 1 and weight 2. When you just find weight 1, 1 minus weight 1 will be weight 2. So here we have Netflix and Apple in my case. In your case, it is taken from the spreadsheet, online spreadsheet. You need to take two of the individual stock. And then the problem is how we can, now the question is how we can optimize the portfolio, right? In other words, how we can find the weights of these two assets. Let's start Excel application. So you first, my stock is Netflix and Apple. You can see I directly put, I don't use excess. It's just directly use I use. Then these are individual stocks, you can see, okay? Individual stocks. But what we just do, we use the return because these are the prices. For instance, Netflix 58.48 is price. I use the return of this Netflix and return of Apple. Then here you can see we have formulas. Okay, here. And this is the graph. You can see is taken from here. When you just paste your own stock prices, it already provides the graph. So you take the graph and paste it. Okay, and then continue to evaluate. Now the question is how I will prepare this table. Look at the Excel table. Here, we can see we have standard deviation. And then you can see that I already calculated the weight 1 with the formula that I provided to you here. Can you see? This is the optimal portfolio weight formula you can see. Here, in each of this sample, actually, I just use rolling window weights. Okay. So weight 1 and weight 2 is already calculated inside Excel, right? In quantitative finance course for the next semester, I think it's like we have elective course. In that course, I use these steps and then I use a program like R programming to estimate these optimal portfolios and more. Even in that course, we will take more than 2 assets. Because as you can see, when you just take 3 assets, this formula becomes more complex because you have now weight now you have weight 1, weight 2. In that case, you have weight 1, weight 2, weight 3. Then the formula becomes more complex. Therefore, they use a computer program. But for this course, since it's like an introduction to like finance applications, we just use 2 stocks and then use Excel. So weight 1 and weight 2 is already calculated. Correlation is already calculated. You can see correl function. And then let's continue. You can see that it's calculated. And we take weight 1 from the formula, weight 2 from the formula. And now the question is how we can calculate portfolio risk. You look at the formula. Can you see the formula link? So we calculate the portfolio risk, which is a variance here, is already calculated. And what about portfolio return? How we can calculate portfolio return? Weight 1 multiple with first stock plus weight 2 multiple with second stock. Then we calculate portfolio return as well. Okay, Excel calculates everything. And then how we prepare the table? Let's go back to table. Here we take the last weights here. You can see weights are here, weight 1 and weight 2 here. The last weights, in order to see that last observation, weight 1 is minus 0.09. Weight 2 is 1 point, here you can see 1.0939. So I take these variables and paste. The question is how a weight can be negative? Because it's like an you can, although you don't have stock, if you think that you can sell this stock, which in Turkish is açığa satış, okay? It's like a negative value, but the sum is equal to 1, as you can see. So what it means? It means that sell Netflix, although you don't have, right? Then buy Apple, okay? Sell by. So therefore, this sum is always 1, but any weight can be negative, okay? Like an open sale, okay? You don't have the stock, but you just give the sell command, and at the end of the day, you just closed your open position, okay? So, and the standard deviation, look at here, standard deviation is already calculated as well. Here, let me take it here and show you. So standard deviation for Netflix, standard deviation for Apple, and the correlation is 0.62. So you need to update this table. And now the question: what is optimal portfolio, and how we can find the graph? Look at the optimal portfolio. It is already calculated. You just take the graph and paste. And then portfolio risk and return. It is again already calculated. Risk and return, you can see. Here from the graph, this is a good graph of this one. You can see that we have, let's say, higher risk, high return, sometimes decreasing. We don't have, of course, one-to-one relationship, but it seems that when we have a higher risk, then we have a potential increasing for portfolio return. Yes, this is the end of final project. Now your questions for portfolio optimization. Any question?
Hocam, I have one.
Yes,
Hocam, for the portfolio optimization part, should I keep Apple as the second asset, or do I need to choose a different company to pair with my stock?
You're in Excel file. You have the stocks already written, like Cisco, GSX. You need to take both of them and then replace it with Netflix and Apple. Remember, for CAPM and arbitrage pricing theory, you selected first individual stock return, individual stock, and even you can look at your online spreadsheet that I sent, data one for arbitrage pricing theory and CAPM, as you can see, and portfolio analysis with additional stock means you will take the first and second one, both of them. Okay, then replace it with your own stocks you already selected from the spreadsheet. Okay.
Okay, thank you. Thank you.
So when you just update it, all of the values will be updated automatically, even the graphs. Okay. Even the graphs will be updated automatically. And then you will just paste and then evaluate the result. Yes, any other question? No question.
I have a question, hocam.
Yes, Aydın.
For portfolio analysis, in the beginning of analyze, how do we know the standard deviations without knowing the weights and variances?
Here, when you just select your two individual stocks, okay, this individual stocks, here the Excel calculates the returns. Then standard deviation, it calculates standard deviation correlation, and then optimum portfolio weight is calculated with Excel. At the end, you select the last observation so that all of this standard deviation weights correlation is calculated inside Excel. I don't know if you can see the Excel link formula here. You can see that the formula already given in the Excel file so that it already calculates. So when you just paste your own data, it will automatically calculate. Okay, Aydın.
Hocam, can you show a sample to make an example?
This is a sample. This is my two stocks, okay? So when I just put my stocks, it calculates the returns, excess returns, standard deviations, correlation, and weights. So everything is calculated inside the Excel, and then you will take the last observation for standard deviations, correlation, and portfolio weights. Then go to Excel file here and update this Word file, project. You update these variables, weights, standard deviation, and correlation. Instead of taking average, I just take the last observation because you can see that portfolio optimization on October 2024. In your case, it will be like portfolio optimization on December, or even December will not be available because we need to have industrial production and other observations like November or even October. Probably October we will have October 2025, and then you will take the last calculations for standard deviations, correlation, and portfolio weights. It's already calculated inside the Excel file. Okay.
So, hocam, we will make a general portfolio analysis by looking the only last data.
Exactly. Normally, although we report the graph here, normally we report the graph actually, optimal portfolio weight. You can see. We calculate, we show it. And portfolio risk and portfolio return, you can see that we calculate rolling window for each of the months separately according to optimum portfolio weights. But for this table, we just report the last month's weights, standard deviation, and correlation in order to see the general picture for these two stocks. But when you just look at this graph, optimal portfolio weight, okay, you can see it says decrease Netflix and increase Apple. Let's look at what happened during 1 year. This is Netflix. Okay. And this is Apple. monthly. We just set here decrease Netflix, but as you can see, Netflix increased. Apple increase Apple. Let's see here, around here. You can see that since it's a limited capability, he could not catch up the short-term movement. But over the long run, yes, here Apple increased from 243 to 286, and Netflix. Let's look at what happened to Netflix. Even it's increased from 87 to 109. So both of them are increased. But still, we just said that Apple, keep Apple more, especially after the periods. So is it clear, Aydın? So we just take the Excel file, paste it, and then it calculates everything for us. Okay, the links will calculate directly.
Hocam, can we also find the portfolio analysis like other stocks such as Borsa Istanbul or gold?
You
Like
can do this,
different
but for project, we just have for project, you need to use stocks from United States. For Borsa Istanbul, you need to select 2 stocks and then put and practice. But for our term project, you need to use this Nasdaq returns, Nasdaq stock returns you need to take. So all of them are from Nasdaq, as you can see.
Okay, hocam.
Here. Right. All right. Any other question?
Hocam, as the results, how many graphs do we need to get or do we need to show in the project?
So here I just sent the template. You can see like for CAPM 1 graph, for arbitrage pricing theory 1 graph, for portfolio optimization 1, 2, 3 graphs. So these are the graphs. So you need to update this term project and then send via UZEM system. All right. And in quiz, I will also email you. You need to bring me the first cover page and sign it. All of the students must sign. And then bring me 1 cover page that all of the students signed in next week. Before the quiz, I will collect. Okay.
Hocam, how many days do we have for the project?
How many days left is 26th of December. I will also email today. The deadline is the last day of class, 26th of December. Okay. It's more than 3 weeks you have.
We will upload it through UZEM or?
You will upload to tourism, but next week you need to bring me cover page, signed cover page. You need to sign and bring me cover page next week.
Thank you.
Right. Let's take 5 minutes break. Then we can continue. Okay.
Çalıştığınız robot o zaman yarınki toplantı ne
Yes, now we can continue with our comparison methods chapter. I will cover some of the parts for quiz. Then after the quiz, we can continue with this chapter. I use Fraser's book, Engineering Economics, Financial Decision Making for Engineers book, chapter 4, Comparison Methods. Okay. So here, what we know about engineering, finance, and economics, investment is the central point, as you can remember the beginning of this book. We have investment, therefore we need to evaluate the return of this investment and then try to see if we have positive return or not. So these investment opportunities are often referred as project in industrial engineering. Okay, so engineers, finance experts, economists try to understand if investment opportunities is profitable or not. So how we can understand if an investment is profitable? We can use comparison methods. Okay, so then if we just try to classify a project correctly, then we can select the best option, which is let's say best higher return by using this method. And then we have a few comparison methods to evaluate the project. We have present worth analysis, which we will see today. It tries to look at present worth of all cash flows. And we have annual worth. In this case, we try to convert all cash flows into a uniform series, like an annuity. And then we have payback period. We will also see this part today. It tries to estimate how long a project can cover payback the investment. Okay, and we have mainly 6 assumptions for these comparison methods. Firstly, all costs and benefits are measurable in terms of money. So if we cannot convert a benefit or cost to money, then this method cannot be used. Like environmental costs, we need to convert and then deduct. And future cash flows are known with certainty. So what we know, future cash flows is actually unknown. But this comparison method thinks that we have a known future cash flows. Okay, it's valid especially for payments. When you just buy a production machine with credits, you know how much we will pay. What about the problem? Problem is the cash inflows because of demand uncertainty. Even we have some tools for demand uncertainties, and then we try to, let's say, forecast cash flows. But here we will take given cash flows. And then we have another assumption that cash flows are unaffected by inflation or deflation, because we directly use cash flows, so we don't adjust it with real values, okay, which is another assumption. Of course, we can just use some tools to adjust with inflation, but here we will take that cash flows are not affected by inflation. And then another assumption is that we have sufficient funds are available to implement all projects. Because if you try to evaluate, let's say, compare the projects, it means that you have enough money to invest. So if you don't have money, then why you just try to compare it? Therefore, we have sufficient funds are available. And then taxes are not applicable because according to, let's say, different taxes, we may have different tax rates for different investments, so that in this case, we will just fix that tax are not applicable for these projects. And then another assumption is that all investments have a cash outflow at the start, because we have first cost, initial investment, then we have return. But what we know, some projects may have even inflows at start, but then they may have cash outflows later on, especially when you just have credits. But even when you just take credit, it's actually an initial investment. Okay, we invest, although it's not our own money. So we can classify the projects into two groups, like independent and mutually exclusive projects. So independent projects, like our expected cost and benefits for each of these projects do not depend on other projects. And mutually exclusive means when you just select one project, all other alternatives must be excluded mutually. So this is two classification. And another classification is that we have related but not mutually exclusive. So when you just select a project, expected cost or benefit of this project depends on whether other is chosen or not. So it's like we have not mutually exclusive. We can just some combination. For instance, we can select one of the project and then select other. So it's like related, but still we need to select with different options. Okay. So if one project is contingent to another, which means that, for instance, the project can be done alone, or the two projects can be together. But what we know, a project cannot be done by itself. It's a contingent to another. So for instance, you have an investment for production machine, and then you have another supporting project, but this new supporting project requires initial another investment. So it's like contingent project. And then what we have sources of financial constraints. It means that we have limitations for resources or finance capability. It depends on our budget. Okay. So let's see what type of projects we have. N projects, as you can see. Independent, evaluate each project separately. Mutually exclusive, rank and pick the best one. Related but not mutually exclusive, you can organize mutually exclusive setups up to second projects so that you can rank which project you will select. Okay. So the question is how we can now evaluate these projects. The first tool is minimum acceptable rate of return, MAR. So that investing in a project implies foregoing the opportunity to invest another one. So minimum acceptable rate of return is the interest rate that must be earned in order to project is accepted. It's like think that you bought a production machine with 50% interest rate. And then what you expect, your return must be higher than this 50%. Otherwise, you will not say, okay, I don't buy this production machine because my return is not 50%. So it's like minimum acceptable rate of return is usually compared with the cost of finance. Okay. So what we know, projects that earn at least this minimum acceptable rate of return is attractive and acceptable. If the rate project earns less than this minimum acceptable rate of return, then you say, okay, it's not desirable. I don't select it. So it's like MAR, which can be read as rate of return required to get investor to invest in a business. Okay. It's also known that it's a company's cost of capital. So this MAR, which is minimum acceptable rate of return, should satisfy the expectation of financial institutions lending the money at a given interest rate, which means that interest rate of credit, and then shareholders taking their capital for investing in a project. So like this return, a project return, must be higher than the cost of this investment. Secondly, shareholders should think that yes, we can take this risk because it's higher, still higher, return is higher, but since a project it means risky, it means that this minimum acceptable rate of return is accepted by shareholders because they take risk by investment. So, what I explained
Hocam,
there,
I have a question.
yes.
What is the benefit of compare more than one projects in one time? And secondly, so how can we determine the relations between the projects? Which relations, what relationships between this kind of projects have?
So, firstly, how we just evaluate, we need to look at calculate the cash flows. We will also practice now, and then try to see the present value and compare it with our cost interest rate. How we can, let's say, select different projects. We need to, for instance, you have an option to invest on production machine A and production machine B. So it is determined by you that A and B are options. So options are determined by shareholders. Then we try to see their future cash flows, then compare which is profitable. You can remember that with time value of money, we also learned how we can bring the cash flows into today or future. So how you can know that it's an investment opportunity? It depends on the shareholder risk-taking behavior. But we need to write down the investment opportunities firstly. Otherwise, we cannot compare. Okay, Aydın.
So we should convert always the same period time to compare the projects.
We should always, if you would like to compare it, it's just the same idea as with time value of money. In order to compare if a project is desirable compared to other projects, you need to bring the cash flows to today and then compare, or even you can bring cash flows, inflow and outflows to future and then compare with the same period. Then we can say, okay, this project must be selected instead of others, right? So we will always like present world analysis. For instance, we try to compare projects by computing their present worth at this MAR, or annual worth. We compare projects by computing their annual worth MAR. Okay, so again, we try to select the project that has got the greatest present worth. You can remember from time value of money with the same approach. Okay, so if present worth of an independent project is bigger than zero, it means that it has a positive return, that it's acceptable. If it is less than zero, then it's unacceptable. If it is equal to zero, then it's marginally acceptable because we don't have lost, at least. We will look at. And now the question is how I can calculate present worth of n-year annuity. Okay, here we have annual net cash inflow, A, multiple with 1 minus 1 plus interest rate power of minus n divided by interest rate. Okay, this is present worth factor. So we will use this formula. So let's see a long question, but solution is not very long. Steve Chen, a third-year electrical engineering student, is really into gaming. He and all of his friends like online multiplayer games, but are annoyed by delays caused by slow internet connections. Sometimes they link their own computers into local networks and play, but it's hard to find a place to play, and their laptops are not the best machines for gaming. On his work term in Abu Dhabi, Steve noticed that gaming halls are popular. High-level networked game machines are located in malls, and people rent the machines by the hour for playing games, either with each other or over a very fast internet connection. So that Steve expects to be on campus for the next 5 years and sees an opportunity in setting up a similar business at the mall next to his university. So he takes the idea and then tries to think that we can just do the same investment just in the mall next to the university. His first cost for equipment, furniture, and software is expected to be $70,000. Students will be able to rent time on the computers by the hour. Steve will be able to augment his income with some unexpected services. Net annual cash flows after paying for labor, supplies, and other costs is expected to be $30,000 a year for 5 years. So we have 5 years, as you can see. When Steve finishes his graduate program in 5 years, he plans to close the business. The 5-year-old equipment and the furniture are expected to have zero value. So like after 5 years, its salvage value is equal to zero, it means. If investors in this type of service enterprise demand a return of 20% per year, is it a good investment? You can see that we have demand a return of 20% is the critical point for us. Okay, so firstly, what is your net? What is Steve's initial investment, P0, which is cash outflow, is 70,000. Net annual cash flow, which is 30,000 for 5 years. And required return, which is the interest rate required, is 20%. And then salvage value is equal to 0. So the present value is equal to, as you can see, our new investment here, 70,000 is the minus value. So here in the formula, present vault doesn't include. If you have a cash outflow, you need to put as a minus cash outflow to formula. So minus 70,000 plus A is your annual cash inflows, okay? Multiple with 1 minus 1 plus interest rate, okay? Power of minus of power of minus n. Here in the interest rate is 20%. 1 minus 1 plus 1.2 power of minus 5 divided by 0.2. At the end, this value becomes 89,717, and totally we have plus 19,780. So since present vault is bigger than 0 at a 20% required return, the project is acceptable. Okay. Here, with this approach, you can see we try to see present value of all these cash inflows. Even we can use annuity formula, annuity table here. But in quiz, you will have similar question like this, and then you need to solve it. Okay. So here, what we see, present vault is positive. So look at here. It says if the present vault of an independent project is bigger than 0, it is acceptable. All right. So any question for this part? Present vault.
Hocam, should we think that the required return, that means called I, 20%, so we think that is an interest rate or it's different?
Okay, it's actually interest rate, but the required interest rate, required return from this project. Because it's like we expect that return of this project actually in 5 years will be equal to 20%. So with this formula, we try to see if the return is equal to 20% from this investment every year. Then if I bring all of the values today, it will be if it will be positive or negative present vault. Okay, if it is positive, then we say, okay, this investment is profitable. If it is not, we say, okay, this investment is not profitable, right? So is it clear?
Yes, hocam. One more question I have.
Mhm.
If there was a salvage value, now it's 0 in this question. So
Mhm.
what happened and what should we do?
Okay, if you have a salvage value, then since it's like after 5 years salvage value, you need to bring it to today. This, for instance, after 5 years, we have $10,000 salvage value. What is present worth? Present worth is I need to take this $10,000, bring it to today, okay, with the interest rate factor. In this case, it's not a required return, but it is the interest rate, for instance, for credits. Okay. Therefore, we just think that it's a salvage value is equal to 0. If it's not equal to 0, you need to bring it to today and then add to present worth. In that case, it will be even bigger than this $20,000 if you have salvage value. Okay.
So it's a positive situation, right?
Exactly. Salvage value is always positive situation, which means that at the end of 5 years, because here you can see that Steve, when he finished the business, he has computer, furniture, software. So he sold, and then it's a positive return, right?
Okay hocam.
So here, look at the picture. First cost is 70,000. And then what happened? If, for instance, investors will be willing up to pay this application to $90,000, right? Then, as you can see, it's like Steve will cover 70,000 and then he will make a profit with $20,000. So if he sells immediately this investment, because he knows that he's already profit of $20,000. Okay, it's like the value of this investment is actually normally you invest $70,000. What about the firm value? Now it's equal to $90,000, and $20,000 comes from present worth, as you can see. With initial investment, you just have $20,000. So if Steve immediately wants to sell this company, he can say that, okay, with these cash flows, its return is $90,000, and then what you offer for me, okay? So I will explain this part later on, because after the quiz, I want to explain. We will cover this part after quiz. Okay. I want to come to payback period because I want to ask question in quiz. So payback period is the number of years that it takes to cover an investment. Okay. So how you can calculate? Your first cost divided by annual saving will give you payback period. Of course, here we don't have inflation. We will also see the inflation adjusted. So what we know, if the project has got a shorter payback period, then it's better because it means that we just initially covered this project. If the payback period is in 2 years, then it's often acceptable because 2 years is forecastable, okay? And more than 4 years is usually unacceptable. Like today, you make an investment, and then this investment will cover the cost in 10 years, for instance. Usually, it's not accepted, okay? So let's see how we just calculate payback period. Alex ran a second-hand book business out of their home where they advertise and sell books over the internet. Their small business is becoming quite successful, and they are considering upgrading their website to operate on a cloud server to give them more reliable uptime. The cost is $50,000. They expect that the investment will bring about an annual saving of $20,000. So $50,000 every year you receive you invest $50,000, and every year you receive $20,000. It's like after the 3 years, after the 2 years and less than 3 years, you will cover. You can easily understand. So what's the payback period on this investment? Assuming that saving occurred over the whole year, which means that saving is same over the whole of the year. So how is that calculated? Payback period is first cost divided by annual saving. So $5,000 divided by 2,000, which is at 2.5 years. So you cover the project in 2.5 years, right? And then advantage of this payback period is easy to understand, okay, even for, let's say, low-educated people, easy to calculate. And then it accounts for need for to recover money quickly. And then what we know, feature may not be known with like some precision. And then we may not make sense to use like real finance methods, which is present word analysis. But here we have disadvantages. So it first discriminates against long-term projects. Like sometimes long-term projects is better, but here you eliminate. Ignores the effect of timing of cash flows. This is another problem because what we know, we need to take the money to today and then compare, so that even it ignores the, let's say, the payments, different payments. For instance, first year no saving, second year no saving, third year huge saving, which means huge in return, fourth year no return, so that it is not suitable for these irregular cash inflows. But for finance, of course, timing of cash flows is critical. So let's see two projects and take first calculate payback period, and then we will look at discounted cash flow. Two independent investment opportunities are shown below. What is the payback period? If you look at a three-year payback period, should none, either or both be purchased? Here you have first cost, annual revenues, annual costs, scrap value, service value, etc. As you can see here, your annual net benefit is equal to here annual revenues minus of annual cost, which is equal to $3,000, right? And the payback period you can see is your first cost is $15,000 divided by 3,000, which is equal to 5 years. Here you can see annual revenues minus annual cost is your cash inflows. Okay, you even do not consider scrap value with this method, right? So for machine B, first cost $20,000. Annual benefit is your annual revenue minus annual cost, which is equal to $3,000. So payback period is 6.7 years for machine B. So what we see, so if you require a 3-year payback period, should none, either or both the purchased? As you can see, both of has got over than 3 years payback period, therefore you reject. Okay. And now the discounted payback period. Discounted payback period takes the time value of money, okay, which is important because what we know, 2 years, $10,000 is not equal to 1 year later of $10,000. Okay. So let's see.
Hocam,
Yes.
in previous question, why we ignored the scrap value?
Because here in payback period, it doesn't take scrap value. Okay, like normally we just a simple formula takes cost divided by your return. Scrap value usually do not taken. Why? Let's look at machine A in 5 years. A scrap value inside this 5 years. But for machine B, as you can, scrap values outside of this 6.7 years, because machine B will receive the scrap value after 10 years. So due to this problem, we even do not consider the scrap value. We only take a first cost and annual benefits in order to see the payback period. Therefore, it's a premature method. Usually, we should not have scrap value. We should have very short period, but still, we don't, let's say, discount which is we don't solve the problem of time value money, because each of the money has got different time value. Is it clear why we just do
So
not?
will we always ignore the scrap value, or
Exactly. For payback, standard payback period, we should ignore it due to this problem, because the scrap value might be inside this payback period or not. It's unknown. For machine A, we don't, as you can see, it 5 years, it's inside the payback period. But for machine B, as you can see, it's outside the payback period. Right?
hocam, also we didn't convert the annual value to the present value.
Yes, because it's not a discounted payback period. It's a standard payback period. We will do this next. So converting with the interest rate is discounted payback period. Let's see discounted payback period. If you have $20,000 and if the interest rate is 10%, then here's how we calculate $20,000, 1 divided by 1.1, power of 1, which is equal to 0.90, you can see. If you have second year, you can see 1.1 power of 2, 1.29. 1 divided by 1.21, which is equal to 0.8264, you can see. So with discounted payback period, we just take each of the cash flows and discount it to interest rate given to us. For instance, if the interest rate is 10%, as you can see, if you have $20,000 every year, you can see that you have not equal cash inflows in year for $20,000. But when you just bring this $20,000 to today, it is equal to $13,000. Okay. So here you can notice that when you use discounted payback period, you bring it to today, and then the sum of the, let's say, your cash inflows for present world is less than the unadjusted, which is standard discount period method. Therefore, this discounted payback period brings all of cash inflows to today with discounted interest rate, right? So, is it clear? For this question, for instance, you can practice. If interest rate is, let's say, 10%, how you will solve it? You can see that if the interest rate is 10%, your annual benefit will not be here for payback period. You need to bring it to today. Okay, let's say convert this $3,000 to today, and then you can see for each of, for instance, for first year, you have not $20,000 return, you have $18,000. For second year, you have $16,000. Third year, $15,000. Fourth year, $13,000. And then, what is the, for instance, in this case, instead of using a simple formula, 1 divided by your cash outflow divided by annual cash inflow, you need to look at if your investment is equal to, for instance, $40,000. Let's sum these values. 18,180, 16,530 plus. Still, we don't have. You can see that our payback period is over than 2 years. Okay, and the third year, second year is equal to how we can calculate discounted payback period here. So for the first year, we have 18. Let me take it. Okay, it's already taken. So these are our cash inflows, right? Okay, these are cash inflows. And then this is cumulative cash inflows. So this is first year, second year, third year, and fourth year. Okay. So if your investment is $50,000, right? Then as you can see, your investment is $50,000. Then discounted period is years. When you cover this, firstly, in 3 years, you cover. And now 3 point what? What's the difference between this from 12 months? It is your difference, okay? So every month, you have this amount, okay? Like every month, you have $1,138 additional. So I would like to see what is the point value here. So how we can find it? Because here we have, we try to find the $50,000, okay, which is close to $50,000. And then the difference between $50,000 and third year is only 260. So for 1 month, you have 1,138. So even it is less than 1 month. So approximately you can say, it's like 3 years is a cover period. Okay, 3 point. If you like to see the let's say exact value for this calculation, it's like here. $0.22 months. Okay, 0.22 months. So that payback period, this discounted method is 3 years and 0.22 months later on, this investment is covered. Okay, but when you use, for instance, regular payback period, you would say $20,000, and $20,000. You can see, you would say 2.5 years this project will cover. But actually what? Actually it covers with 3.22 years, okay, rather than 2.5 years, okay. So is it clear?
Hocam, how do we know in the beginning that the discounted payback period is equal to 3 years?
Okay, firstly, let's look at our example first. Initial investment. I said that our investment is $50,000. Okay. So if your investment is $50,000, then cumulative return should be $50,000. Is it correct? Okay, here. Your cumulative return should be $50,000. It is around here. So that this project is covered 3 years and later on. How do we know? Because investment, I said that investment is $50,000. Your cash inflows in each of the years $20,000, but the interest rate is 10%. So 3 years is the starting point. You try to find approximately when this project will cover. How we know? What is the closest value to 50,000 before is 49,740. Is it, Aydın? Is it correct? Then 3 years. So that we have 3 years covered first. Then only small amount is left. I can even say approximately 3 years later on, this project will be covered. But if you would like to use some approximation, you can take the differences and convert to month, then see the difference between 50,000 and 49,740, then convert to month and say, okay, 3 years and 0.22 months. Or if you convert this value to days, okay, like 0.22 multiplied with 30 days, okay, 7 days. 3 years, 7 days later on, this project is covered with discounted payback period. So is it clear?
Yes, hocam. If we had invest, for example, $40,000, so
If you
it
have
will be
$40,000 if you have investment, if you have, like we have in this case, you can see again, let me take. So if you have first year, second year, third year, you can see that first year 18,180, second year 44,740, third year 49,740. So if you have 40,000 investment, then second year will be the base, okay, year 2. And then you try to find $40,000, okay? So second and third year. The difference between second and third year is equal to 15,000. What you look for? You look for $40,000 because your investment, let's write it. Okay. Your investment is $40,000. So that difference for year, investment difference is equal to $40,000 minus of this value. Okay. So in 1 year, this is your difference. Required investment is this value. Divide 0.35. So 2 years and
hocam,
comma
which
value.
number did we divide?
Okay. From second to third year, you have 15,000 difference. What is the investment to cover to 40,000 from 34,000 to 40 is 5,000. So what is the difference amount is normally in 1 year, $15,000 change, but your investment up to $40,000 is only 5,290. Okay, so that is $40,000. Tamam mı? This project discounted payback period is 2.35 years. Is it clear?
Yes, hocam, clear. Thank you.
So what we do, if you don't care about months and convert it, you can directly take the 1 year difference and the required, let's say, value that you cover your investment, divide, and then it is your percentage value. It's like here. Then you have, let's say, this value plus, let's think. plus this value divided by 2. Okay. So if your investment value is 42,225, then it's like discounted payback period is just equal to 2.5 years, because you take second year and then in the middle of 2 and 3 is just equal to 42,225. Okay. Yes, another question? All right, let me open QR system. But before I need to open it. Yes, you can just read. Okay. Okay. Next week, I think we have quiz in class. Let me open syllabus. Yes, quiz 2. So quiz 2 will contain 2 or 3 questions. Okay. The part that you learned up to midterm exam, plus this week comparison methods chapter. Again, it will be this week. I will read midterm exams results and upload to UZEM system your grades. For second quiz, it will again be classical, no multiple choice questions, 2 to 3 questions. Okay, and see you next week. And plus, don't forget to bring the cover page. This page. The cover page of the term project. All of the students' names should be written, and you should sign and bring me in the quiz date. Okay.
Hocam, I have a question.
Yes.
For the group project, how will we make a labor division between the group members?
So only one student can bring the paper. You can bring, take an output, and then all of the students can sign this one page, and then you only one student can bring, because in quiz everyone will be will join the quiz. Okay? Quiz date next week. So you will
Hocam,
come.
I'm asking about the group projects for study. how will we make a division between each individual person?
Okay, for group project, everyone will just receive the same grade. Everyone. So there is no division between the members. So your project is therefore it's a group project.
Hocam, we
Okay.
have different parts in group. For example, capital and arbitrary and portfolio analysis. Each person should make only one part, or it will be
Okay.
all of
I don't care how you prepare CAPM, arbitrage pricing theory, or portfolio optimization separately or together. You will prepare as group and then submit as group, so that I will grade the project, not the parts. Okay?
as a whole project, right, hocam?
Exactly, as a whole project. It is impossible to separate the grades. That you prepared CAPM, okay, it's your grade. You prepared, it's not. It's group. Therefore, it's the group project. All right. So
Okay,
group
hocam.
project cannot be separated. It's same for all of the classes. If you just select your group member, it means that you accept that this project is done together and then graded together. Yes, another question? No, all right. See you next week. I will also email about content of quiz and then the cover page, bringing the cover page and the time of the quiz. All right. See you and take care.
Thank you, hocam. Have a nice day.
Have a nice day too. See you.